A stunning new revelation out of the fraud trial of Elizabeth Holmes today.
WeWork reportedly talking with advisors and shareholders about possibly scrapping its upcoming IPO.
We are all suffering from the share price performance that was clearly impacted by these two incidents.
$47 billion, $9 billion, $3.5 billion, $3.3 billion, all private startup valuations, all companies labeled unicorns, all later associated with bankruptcy, insolvency, liquidation, or shutdown. In venture capital, one number changes perception: $1 billion. Cross it, and a company is no longer early stage. It is elite. The label signals investor belief in growth, in leadership, in market dominance. But valuation measures expectation. It does not measure durability. Between 2013 and 2019, 5 companies crossed that threshold: Theranos, WeWork, Quibi, Greensill Capital, Jawbone. Different industries, different business models, different leadership structures. Each reached scale. Each later encountered structural failure, not for the same reason. One collapsed under regulatory findings. One unraveled when public investors examined its financial structure. One failed to achieve subscriber adoption. One lost critical insurance backing. One eroded under sustained competition. The billion-dollar milestone looked identical. The stress tests were not. And in every case, the turning point came when belief met evidence. The first test came in a laboratory. By 2013 and 2014, Theranos reaches a reported valuation of about $9 billion. Its central claim: the ability to run multiple diagnostic tests from very small blood samples. If accurate, the model would alter laboratory medicine. Retail partnerships expand. The board includes nationally recognized figures, including former U.S. Secretary of State Henry Kissinger. Media attention intensifies. Then investigative reporting raises technical questions about device performance. That moment alters the trajectory. Regulatory inspections follow. Federal agencies cite deficiencies. Business partners suspend relationships. The sequence is direct: public claims, external scrutiny, regulatory findings, operational consequences, leadership restructures. Stabilization efforts begin, but scrutiny does not recede. On September 4, 2018, Theranos announces it will cease operations and distribute remaining assets to creditors. The dissolution is formal. Laboratories close. Corporate filings conclude the process. If regulatory scrutiny can dismantle a private company, what happens when scrutiny comes from public markets? WeWork expands rapidly. The structure appears simple: long-term lease obligations, short-term member agreements. Scale the spread. Revenue grows. Losses grow faster. By January of 2019, private investors value the company at approximately $47 billion. The company prepares to go public. In September of 2019, the IPO filing becomes public. The prospectus details significant operating losses, governance structures granting extensive control to the chief executive, related party transactions. Public investors reassess. On September 17, 2019, the IPO is withdrawn. Reported valuation discussions fall sharply. Leadership changes, emergency financing, layoffs, asset sales, expansion slows. But lease obligations remain fixed. When revenue softens, contractual liabilities do not. The imbalance becomes structural. On November 6, 2023, Reuters reports that WeWork files for Chapter 11 bankruptcy protection in the United States. Under court supervision, leases are renegotiated, liabilities are restructured. On May 30th, 2024, a judge approves a plan eliminating approximately $4 billion in debt. The company exits bankruptcy, smaller, restructured, operationally altered. That unraveling took years. The next took months. On April 6, 2020, Quibi launches. Short-form premium content designed for smartphones, high production budgets, experienced leadership from entertainment and technology, significant capital raised before launch. The competitive landscape is already defined. Long-form streaming dominates subscription entertainment. Free short-form content dominates mobile attention. Quibi positions itself between the two. Subscriber growth does not meet expectations. Within months, strategic alternatives are evaluated. On October 21, 2020, reporting confirms plans to shut down. On December 1, 2020, operations cease. From launch to closure, less than 1 year. The content existed, the platform functioned, adoption did not scale. If consumer demand determines survival in months, what determines survival in finance? Greensill Capital operates in supply chain finance. It advances payments to suppliers, packages receivables into financial products, sells them to investors. Its model depends on continuous investor funding and insurance coverage protecting against borrower defaults. On May 13, 2019, Reuters reports that SoftBank's Vision Fund invests $800 million, valuing the company at approximately $3.5 billion. Expansion continues. Exposure increases. In early 2021, insurance coverage critical to its funding structure is not renewed. Risk calculations change. Investors reassess. Funding tightens. Liquidity pressure intensifies. On March 8, 2021, Reuters reports that Greensill Capital files for insolvency. Administrators review assets and liabilities. The unraveling is procedural, but structural. Not every collapse is sudden. Some accumulate gradually. Jawbone begins with Bluetooth headsets. It expands into speakers and wearable fitness devices. Consumer hardware is capital-intensive. Competition is persistent. In February of 2014, Reuters reports that Jawbone raises funding at a valuation of $3.3 billion. Over time, reports cite product delays. Reviews vary. Inventory and pricing pressures increase. Layoffs occur in subsequent years. Valuations are marked down. Attempts are made to pivot strategy, but sustained competition reduces financial flexibility. On July 6, 2017, TechCrunch reports that Jawbone enters liquidation proceedings. Assets are prepared for sale. Operations cease. No singular trigger, only accumulated pressure. 5 companies, 5 different failure mechanisms. Theranos ceases operations in September of 2018. Jawbone enters liquidation in July of 2017. Greensill Capital files for insolvency in March of 2021. Quibi shuts down in December of 2020. WeWork files for bankruptcy in November of 2023 and exits in May of 2024 after eliminating approximately $4 billion in debt. Each crossed $1 billion. Each later faced dissolution, insolvency, liquidation, or bankruptcy. A unicorn valuation assigns a price in private markets. It reflects investor belief at a specific moment. Durability is tested later by regulation, by public disclosure, by consumer adoption, by liquidity access, by sustained competition. The billion-dollar threshold marks expectation. What follows is determined by evidence,